Here to talk about what all this means for your markets and the money, Jason Trennert, Chairman and CEO of Strategas Research Partners, a Baird company. And start with something we probably do agree on. And did you ever notice the word progressive? Isn't there a better word for what is that? Does it lead to progress? Those policies?
No, it seems pretty regressive to me. I
just love it that it's called progressive, but everything sort of leads to
the government taking over every part of your life.
It takes us backwards.
It doesn't seem like much progress to me.
Okay, now back to where we're. So we're up about 16%, I guess, from the October lows. Have, in your past, your storied career, have you ever been on the you're posing? Have you ever been in a position where you start to your beliefs are shaken and you finally have to just throw in the towel?
Of course. Listen,
and that's not going to happen. You don't foresee that happening.
I don't perceive it happening, Joe, because I think the fundamentals ultimately went out, and I think the fundamentals, as far as they're shaping up for a recession, I think the case is extremely compelling for the second half of this year going into next year. Now, again, this is the most widely anticipated recession of all time. I understand that, and I have a lot of our clients say, if this is the most widely anticipated recession of all time, why is there going to be a bear market? Everyone understands this, but if you look historically, that's never happened. The market always bottoms after the recession starts, and we've also had 12 or 13 years of quantitative easing, which I think has obscured people's expectations about how quickly these things happen. We've all gotten very accustomed to seeing V-shaped recoveries, V-shaped bottoms, and this is more, in my opinion, more of a traditional business cycle, which is driven by credit conditions, driven by higher long-term interest rates, Fed tightening. There may be an event at the end of this, but I think so far this is just taking time. So the Fed's not going to be able to
stabilize things as they have in the past or come to the rescue, and that means this is different than we've seen in a couple of decades. I think
the Fed put, in my opinion, for now, what would make me bullish, Joe, you asked me that before, what would make me bullish is actually if the Fed just threw up its hands and said, you know what, 4% inflation, 5% inflation is like, that's the best we're going to do. We'll do yield curve control. We'll start buying treasuries. Then I'd say you buy the market with reckless abandon. But the Fed is giving you no indication that it's going to do that. The Fed is saying, listen, we have our suicide vests on for 2%. This is it. I don't think that's going to be the case ultimately. I think if they get to 3%, they're going to stop tightening. But right now, the indicators that have come out over the last couple of weeks actually support more Fed tightening rather than less. And they may pause at the next meeting, but I also think that the Fed is not done by a long shot.
So if they were to do that, you would say you'd buy with both hands and be very bullish on the markets, but not necessarily the economy if inflation is still running at those levels.
It would be terrible public policy. In the same way, I think 12 years of quantitative easing was ultimately terrible public policy on so many ways. Very regressive, much better for wealthy people than the average person. Massive inflation in financial assets, terrible allocations of capital. But, a lot of policies might be good for the markets, but not great for the average person.
I would think that if we had to go to 8% instead of 5%, that might give you what you're looking for. Do you think you think it's going to be that stubborn or something?
No. I don't think you're going to have to.
What kind of horrible thing would happen? Because you're saying it bottoms. You mean below 3,600? Do we need?
No, we could revisit that. We're using $200 for S&P 500 operating earnings.
And what multiple?
I think a 17 multiple. We did an econometric model, whatever that's worth. It gives you 3,400. Let's say you're in the same range as what you saw last October.
That would be from 4,200. That's it's a meaningful 20% drop.
And I do think that's the risk. I really do.
The risk or the likely?
I think it's probably more likely than the risk for me in my call is that we go up to 4,500 or up to the old highs. I don't see the catalyst for that. Certainly AI, I think one of the analysts on the street described it as a gold rush. And I wouldn't stand in front of those stocks because there is going to be a bit of a gold rush in those stocks. But as we know, the market is increasingly narrow. Without 7 stocks, the S&P 500 would be down. Now it still counts if you own an index fund, you still get credit. But the irony is that if you're buying an index fund, you're largely doing that to diversify risk. And increasingly, you are concentrating risk in a very small section of stocks. Now, they're very good stocks, very good companies, but still, that's not really what the product was designed to do.